And so a lot of our clients right now are looking at reducing their payments and paying off high interest debt by refinancing. And so if you're looking at setting up a home equity line of credit style mortgage, a readvanceable product like this, a lot of people also look at, well, maybe what I should do is I should access some additional capital and pay off some high interest debt that I have. Maybe I should lower my payments while I'm at it. Especially for our real estate investors, extending your amortization out to 30 years will give you a lower minimum monthly payment that then allows you to go out and qualify for more debt when you go buy rental properties. So a lot of the time, the residence becomes the hub of your investing strategy, regardless of whether you're investing in stocks or real estate. It's very important to set this residence up, and that's where our team can give you a lot of good advice on how to structure that. By the way, I'm going to answer all the questions at the very end. So just a heads up, I'll make sure that I'll get to every question that you guys have, and I'll open up for some questions at the very end. One of the things that a lot of our clients are doing is learning how the Smith maneuver can save them thousands in taxes with very simple changes. I have an easy example of this actually. So I had a client who had an ICBC settlement, and she was going to use her cash for down payment. In fact, she talked to her banker already, and her banker said, yep, no problem. You're approved. Go ahead, go buy a rental property, and we're going to use that cash. However, one of the keys here is by restructuring her mortgage. So what we did is we actually took the $100,000 in cash, and we paid down her mortgage by that much. But then we gave her a line of credit behind it that was available to her so that when she found an investment property, she still had that credit available. So then what she did is she went out and then she found a rental property and then borrowed her down payment from her residence. It was a very, very simple maneuver, but simply by giving her a little bit of tax advice and saying, hey, make sure you go talk to your accountant. This should work for your situation. But now if you're reborrowing the $100,000 back out, at the time, interest rates were around 3%. So that's about $3,000 per year in interest costs she's now writing off. And based on her tax bracket of around 25%, she's now saving about $750 per year in taxes every year. It's pretty substantial, and it's a very, very quick, simple maneuver. And there's a lot of more complex maneuvers too that I won't get into today, but there's a lot of more complex maneuvers that a lot of our clients are doing as well. Getting access to capital and investing it to earn a spread on the interest versus the return. I've actually had a number of clients that broke their mortgages, and even at some periods of time, obviously in the last little bit, interest rates have come down significantly. However, I've even done this for clients when interest rates were rising and they broke a mortgage at a lower rate and to take a higher rate. So they paid a penalty, got out of their lower mortgage rate, took a new higher interest rate, also that they could get access to an extra $100,000 or $200,000 in capital. And you'd wonder, well, why is that? Why would you pay a penalty to get rid of a mortgage rate that's at a lower interest rate? Because you'll have to look at the full picture. If this client, and I'll use one client in particular, he was getting access to another $200,000, and he had some investment ideas where he figured he's going to get something like 15% return on his money, which, hey, I thought that was a little bit high, but he was pretty sure that he's going to be able to get that. So by investing that money at 15%, and at the time his cost of borrowing was a little under 5%, he's creating over a 10% spread on $200,000. That means he's earning $20,000 per year on an ongoing basis by breaking his mortgage and paying this penalty. So his cost to break his mortgage and get into a slightly higher interest rate was only costing him about $2,000 per year on the difference in interest. And so he was way ahead. His net savings and his net worth increase per year is actually going up by $18,000. And so again, it can sometimes make sense to break your mortgage and pay a penalty if you're going to get access to more capital, and if you're going to use it to invest, and you make sure that you run the numbers on that. Another thing that, of course, a lot of our clients are doing is utilizing their home equity to buy rental properties. And again, that's one of our niches here at Green Mortgage is accessing home equity to buy rental properties. Now, there are a lot of different strategies as well that can get you there even faster. So the Smith Maneuver Accelerator. So there's a number of different options here. There's something called the Debt Swap Accelerator. And that's actually the example I gave you with the lady who used her ICBC cash. That was actually a debt swap accelerator move. So that was just taking assets that you have already, using them to pay down your mortgage, and then reborrowing back out to reinvest. And you can do this with stocks. You can do this with a lot of things. So it's a very, very cool, cool way of doing it. There's also something called the cash flow diversion calculator, which is essentially a way of taking the cash flow from your investments to pay down your mortgage even more aggressively. There's a number of other options here. There's prime the pump, cash flow damming, which cash flow damming is a very complex strategy. And for those of our clients that have a lot of rental properties, we do advise that they look into it, especially if they have a lot of rental income. It's a little bit more administratively intensive. A lot more action has to be taken by the borrower, but the tax savings can be quite extreme if you do that.